Well, the January effect is the tendency, or was the tendency, for small stocks to outperform large stocks, small caps to outperform large stocks in the month of January. Our research has shown that most of that January effect now takes place in the last half of December, the last 2 weeks of December. Um, so that's when it starts. You can see the Russell 2000 line is the maroon one, or the dark red, whatever you want to call that. That's
Right,
much
right
stronger than
here,
the
the
others.
solid one, right?
And the dotted. The dotted is
Okay.
post-election year. The solid's
Oh, I just
21
realized
years.
it's not showing up. 1 second. Let me. There's my
Yeah,
cursor.
here we go.
Hmm.
So, we have a chart that we show the Russell 2000 ratio versus the 1000, and you see that turn right around. It starts to bottom and turn where small stocks start to outperform around Thanksgiving. It even begins a little bit in October. You can see the black line's the average there, but um, here we have we put this out right around Thanksgiving. We're just starting to take off, and you can see small caps made new high. I mean, the Russell 2000 made new highs today. Um, Maybe we'll get a little bit of softness into mid-December, but for the most part, it looks like the sort of small cap seasonality is stirring, um, which is positive. I will say one thing that we didn't, haven't mentioned yet: the longer-term history of small caps outperforming large caps. Not looking at the seasonal aspect, but the small fry tend to, come into the game towards the end of the bull. You know, so not that it's over yet, or we might get a little softness next year, but we've got the rate cuts helping the small caps, but just keep it in your mind that that tends to be the latter stages of the bull market when the small caps join the party.
Yeah, and I was gonna just again to remind folks that 2022 was very punishing for small caps. There's been this is our relative strength line here, and the relative strength for the small cap index Russell 2000 has been lagging in a significant way. This is a monthly chart that I pulled up, lagging the S&P 500 in a significant way. Now it's turned up recently, and you can see that in the price performance, but also a little bit in the relative strength. It's got some work to do. But yeah, when you start going into a daily chart, and look, there were a number of, or at least I felt, there were a number of these times where it looked like it was ready to go, and then it kind of, it would break out, and then it wouldn't go anywhere, or it would reverse immediately. We did get kind of this trend earlier in the year, the latter part of the year here, where we just stayed above the 10-week moving average line, based a little bit. And as you mentioned, now, I mean, this is kind of a breakout today, into new high
Yeah.
territory. Mhm. So
We need
since
some
we are talking
confirm
about
on
small
this
caps,
breakout, though, right?
it's what?
We need some confirmation on this breakout, though,
Yes.
right?
Well, I mean, that's the thing is, we saw all these breakouts before on the Russell 2000, and you maybe get 2 days, and then it was like, okay, that was it, kind of. So with the Fed, again, the Fed just announced a rate cut today,
Mhm.
and that was widely expected. There was a little bit of angst, I guess, after the last one, because the last rate cut, when
That's
Powell,
when the
in
markets
answer to
fell
a
off.
question, basically said, "Hey, it's not a lock, that we're going to have another rate cut here," and that kind of panicked folks, and made the odds of a rate cut, really kind of go wild. But what's your take on the Fed action right now, and how do we kind of look at that in terms of what we feel the market may be doing as a result?
I mean, you can see by today's market reaction or market performance, it was a much more dovish cut than people were afraid of or fearing. Um, I think the Fed, is going to have to ease. There's this debt issue that they're going to have to be careful with, the government debt that's got to get paid, and that's no joke. But we're getting towards neutral. They said, I guess I saw that they're saying maybe only one cut, but some of the dot plot stuff next year. There's going to be a new sheriff in town pretty soon, and there's going to be new data. So, I mean, I really think that that's the important part. I think the Fed needs to get back to the business of not jawboning and talking about what they're going to do and just being the guardrail that they were invented or created to be, and go back to the Volcker days of just listening to the bond market and stop trying to dictate policy and comment on everything, and just talk about the data that they're seeing. And if things get out of whack, they come in and they adjust things. There's an old, quote from the minutes from the '81 where Volcker's, talking to the committee about, if the bond market gets out of the range of 15 to 21%. I mean, this was big interest rate numbers. Then the committee will come in and do something, as opposed to trying to lead it. And they probably need to reevaluate their models, considering how they were late on the transitory inflation and maybe a little bit late on the cutting, this time around. So I think they need to stop giving speeches and talking about it so much. I mean, you could see if Powell answers the question on the 29th that not a foregone conclusion or whatever the exact quote was, market drops. I have a chart where we just put a dotted line in there. And then what was it? Williams down in Chile giving some talks said, well, maybe it happens. The futures, the CME Fed Watch futures flip, and the market turns the next day, turns that day on the Friday before Thanksgiving. So I mean, if that is not enough of an indication of the Fed, that the Fed should really not be in the business of uh, making, projecting, and forecasting to the public, then I don't know what is.
Sometimes it feels like it's a test balloon that's thrown out there, and then you've got the other Fed governors that are walking it back if necessary, and if the
Maybe
market doesn't react nicely.
they've been accused of being political so much recently. Maybe if they just went back into their, labs or their databases and spreadsheets and studied the numbers and made, you know, calculated decisions based upon what the bond market was doing, what the economy was doing, we'd be better off.
Yeah. And I mean, to your point, back in Volcker days, if I'm not mistaken, it was one of those things where there was no Fed announcement. It was just kind of,
Yeah.
it just kind of slipped under the radar. You found out about it later. Well, you also bring up a good point, because you said maybe they need to go back to their databases and everything. And with the shutdown, of course, some of that data was missing.
Yep.
Now they were trying to fill in the gaps with some private company data, a lot of ADP for the jobs and everything like that. Now we're kind of getting the data. It's a little bit late. They're skipping some. What do you think that does to the Fed's decision making in that regard?
I mean, it may be good that they need to take may reset things a little bit, kind of like a fast or something. I just the numbers of consumer spending and economic data seem pretty clear. You've got the jolts or the claims, the new unemployment claims is the jobless claims is really important. That's held up. I mean, there's been some weakness there. I think the shutdown wasn't great for the country, the economy, but perhaps it was just a bit of a reset, and maybe they'll be a little more patient with the data coming in and not try to talk up the market or talk up what they're going to do so much. So I'm kind of slightly encouraged that it might refresh. There might be a pause that refreshes.